Welcome to the Best of U.S. Investors weekly report, where we go over Kerry's call and the platinum swing trading call that we host on Fridays. But this week, well, I'm just going to delete a lot of stuff that I was going to offer to you, and I'll share it with you guys later in the coming week. But Eric chimed in on Kerry's call today, or on Friday, and he shared what he is doing with his AEHR position by writing covered calls. And this became a really interesting discussion because if you don't understand what covered calls are, they can be a very powerful way to generate short-term income on positions that you presently hold. And as you're waiting for them to go higher, or if there are positions that are long-term holds that you want to get both a dividend off, plus you want to generate additional income, writing covered calls could be an excellent way of doing that. And Eric breaks this down. Now, Eric is a platinum member of the Best of U.S. Investors channel. He is a platinum member, so he is part of all of the discussions and access to all the different services. But Eric chimes in, and this is what this is all about: community, contributing, being a part of this tribe. And Eric breaks down covered call writing and what he is doing. Check this out.
Any other questions, comments, criticisms? Anything special happening?
I got one for you.
Yeah, Eric.
So since AEHR, since that seems like that's going to be, it's going to be a while, maybe like late 24 or 25 before that one kind of picks up.
Yeah.
I've been looking into selling covered calls, and I've only got about 200 shares, but for every 100 shares you have, you can sell one contract. And if you're willing to go a couple months out, I think the price was around 11.15 today for a share. And if you're willing to go out to like June, you can get paid 50 to $100 to say that you'll sell it for around 12.50 or 15 bucks.
I'm projecting that the price of AEHR at the end of this year will be $11.88, if that's of any help to you.
So only about 50 cents up from where it's now?
Yeah. Yeah,
Okay.
because again, the EV market has to kick in.
Right.
And that ain't going to happen before the end of this year.
Well, my plan is to keep earning income off of it until it gets to a higher price. So
I think that's an excellent strategy. I wish I knew how to do that.
It's not hard, actually. As long as you approve it with your broker.
Yeah.
And you have 100 shares, you can start selling contracts.
What month are you selling at? You're selling in June, and you're selling the 15s?
Let me look. It's I believe it was yeah, so the current one, I just closed out I closed out 2 contracts today that were expiring next week because they were up and I was able to buy them back for cheaper than what I sold them for. So I bought them back for a couple dollars and then resold July 19th 12.50 contracts, and each one was 45 bucks.
They generated 45 bucks?
Correct.
Okay.
And it's the 12.50. My average price is just under 13, or I'm sorry, just under 12.
Okay.
No, just under 13. So I took the 12.50s because the difference is still more. If those were to go through, I'd still make more by selling them at 12.50. So, but then if I were to go out to the 15s, I think it went up to the contracts went up in value quite a bit. So, but then you got to wait longer, I believe.
Yeah. Eric, for those who don't understand covered call writing, would you be willing to explain it?
Sure. So are you able to pull up like an options
Spreadsheet?
options chain on your on the screen?
All right, so
Okay, there we go. So yeah. So on the call side,
yeah.
yep, this is yeah, as long as 100 shares and you approve it with your broker and you have, I believe it's level 2 options. So for example, like the closing price right now of AEHR is 11.24. So let's say you bought 100 shares at 11.24, it'd be $1,124. You can immediately turn around and start selling calls for income against that. So, for example, I picked June 19th, or I'm sorry, July 19th, and I picked 12.50 strike.
So this one here.
There you go. Yep,
Okay.
there you go. And let's see, so the bid is 96. So that's the number that if you sell that contract at, that you're going to get paid up front. So $96 for them to hold your shares and reserve to be sold at 12.50. If it
Okay,
gets
let me
higher
just
than
run
that.
this by. So what you're saying is if I've got 100 shares,
Yep,
they'll give me 95, what I see is $95.
right.
And if it goes over $12.50, I lose my shares.
You're correct. You will keep that. You'll get paid the $95, but you'll also sell your shares at the 12.50.
So if I'm not comfortable with this 12.50, I could go down a level and put it at 15,
Correct.
and I'd get $40.
Correct. Per contract, per 100 shares.
Okay.
So if you were able to buy it at $11 and it executed the contract at 15, you made was that
$400.
$4 on the sale of the stock plus another $40 per contract. So you made $440 on
Correct.
that position.
If it was executed.
But if it shot way past 15, you'd be capping it at that amount.
Yeah, exactly.
So
But-
you'd want to manage your contracts to make sure that if it was going either really high, if the stock price was going high past that strike price of $15, you'd either want to rebuy your contract so that you don't sell your shares, or you would just let it expire and sell your shares at that much and rebuy all the shares at a lower price later on.
Yeah.
But you have to be comfortable with either letting go of the shares or, I mean, ideally they remain below it, and then you keep the full premium, and then you just keep rotating it.
So the way Warren Buffett buys stock typically is he'll sell puts, and basically what that is, if let's say you have AEHR and you own it, or you want to buy it, or you don't own AEHR but you want to buy it and you want to buy 100 shares of it, you may sell the $10 strike price. So you sell the call, which obligates you to take possession of the stock. So you buy the stock at 10, plus you get paid 80 cents or $80 per contract. So you end up reducing your cost basis to $9.20 in the stock. And so that's how he goes about buying stock, is he sell the puts. So he picks up the premium, reduces his cost basis, and buys the stock at the same time with the anticipation the stock will go higher eventually. Does that make sense?
Yeah, absolutely. My broker, I could only get approved for selling calls against shares that I already own, so I wasn't able to actually sell puts in order to acquire shares.
Yeah.
But yeah, I would definitely be doing that if I had that approval. But for now, what I'm doing is I'm just buying the shares outright and then selling calls a few strikes ahead.
It's a great income strategy if you're buying if you own let's say a Walmart, and it's a stock you want to. I'm using Walmart as an example. It's not a recommendation or anything, but it's not a stock typically that goes up and down a lot. Doesn't have a lot of volatility, so you could buy the stock, pick up the dividend, plus sell calls against it, and make income off it. So so let's say you went to let's say you did quarterly call sales. So let's go to July. Let's go to July 19th. And you had 100 shares at I don't know, let's say you got a good price at $55 or something. you don't really want to sell it. So you would sell, look at the charts, see where it's trading at, see where its range is over a longer period of time. Maybe you sell the 65 calls at 56 cents per share, and you have to, which is $56 per contract. Every contract is 100 shares, and you could just generate a quarterly income off a strategy like that, especially if you have a big position in something. When I used to manage money, we would have people who would have like a Bank of America or an old stock that generated dividends, and they loved dividends, but they also needed more income. We would just write quarterly covered calls on them out of the money so they wouldn't be executed. So if they owned it at 50, maybe we sell it at 70, so it's well above the present price. So it's the chances of it being called out were low. So it's a great way to generate income, especially if you're waiting for a stock to make a move like AEHR or
Yeah, and
Sand
with that
or,
premium too, you can use it to acquire more shares in the meantime, or start
Yeah.
building positions in other stocks or whatever. So
This is,
yeah,
Eric,
since it
I'm
seems like
glad you brought this up.
since it seems
Like
like
I'm
AEHR
sitting
is a
on
good one that'll be like a
2,500
year
shares.
out.
I'm sitting on 2,500 shares of AEHR.
There you go, times
That's
25 by 40.
$1,000.
Yeah, easily
$40 a piece, that's $1,000.
every couple months. Yep.
Yeah,
And if you want to be more risky, you can pick a more immediate date
a
to
lower,
expire.
yeah. I'd choose. And again, as I'm just thinking about this, what is the risk? Well, if you understand why AEHR is down and what has to happen in order for it to go up, and you're knowledgeable of that, and you listen to the earnings call, and the guy openly says, we're not going to be going strong until the fourth quarter of this year. Well, you got the CEO of the company telling you that you're probably in good shape. This one I wouldn't do it on.
well, what's interesting is you can look at the premium, give you some insight. Is it a rich premium? So the volume on AEHR on
This is sound.
SoundHound. So the big amount on this is next week, next Friday. A lot of trading in this area. It was down quite a bit. So most likely, and understand options are typically sold. That's how most people make money on options. They sell a call. So like, for instance, let's say they sold this call here, which will expire next Friday. And if we can see a chart of it, maybe not. They probably sold that call around maybe 10 cents. And as you get closer to expiration, it's a time value decay. So the value of that option as you get closer to the next Friday is going to decay. So they made money on the decay of that. It's a form of shorting basically it's a form of shorting an option. And the idea is you sold it maybe a week ago or on the 10th, not the 10th. Let's see here. That's today's trading. So at one point today it was around, looks like 10 cents maybe.
So are you telling me that at 9 a.m. before the stock shot up, it was worth 35 cents?
Yeah. So if you were on the 10th at 9:46, the option was worth 25 cents. You sold that option, you sold that call, and so you sold it at 30 and it closed out today at 6 and you bought it back at 6 cents.
Yeah.
You just made
24 cents.
24 cents
in the day
per share in the day.
And then you're gonna immediately turn it around and start selling another call.
Right. That's how they trade these. Yeah. So the hype over the earnings call produced somebody, 24 cents a
per
share.
Yeah.
Pretty cool. But you got to make sure it goes down. And that's where options get really complex because of the time decay, and the closer you get to expiration, the value of that option loses.
Yeah, this is something that it has a lot of appeal, but it's pretty dangerous if you don't really understand the mechanics
Yeah.
of it.
The way I see it, as long as you're comfortable selling your share at the strike price that you choose, then it's a win-win.
Yeah.
Oh yeah. I think covered calls it's the most conservative way of trading options. Plus it generates income. It's a little complicated when you submit your tax forms, because if you do it a lot, you got to explain it. A lot of CPAs don't understand it. So you have to
Well,
explain
it's
it.
all going to
But
be short-term capital gains, wouldn't it? Or is it just
yeah,
income?
no, it's short-term capital gains.
Okay.
Yeah.
Yeah.
But I think you can do them in, I think you can do it in IRA, if I remember right.
Okay.
Yeah, but
It seems like those AEHR premiums are pretty high. So to me, that means somebody knows something, and that's why those premiums are higher, because it's likelier that it's going to go up in the future.
yeah, it's a good
Okay.
point. Especially I wonder, especially if you go further out, like if you went out, if you bought a leap, which is expiration is 9 months or longer out. So if you bought a January or a May 2025 call on AEHR, you probably pay a sizable premium for it. But if there's a lot of volume and a lot of interest in that, you could probably really bank out of it, pretty well. And it's also,
Well, for instance, December, those exact same calls for the 1250. If I sold 100 shares, I'd get paid $225 to wait till December.
wow.
Per 100 shares?
Yes.
So what is that a month? If you divide that by the number of months, what is that?
Well, that's the thing, is it's actually less than picking a earlier expiration
Yeah.
date and then doing it over and over again.
Yeah.
Yeah. Yeah. Okay. That
Yeah.
sounds like the way to do it, but I need to understand it better.